I'd like to introduce our speakers. To my left is Joe Calianno. He's an international tax partner in the National Tax Office of BDO. To Joe's left is Mike DiFronzo, who's an international tax partner in the Washington National Tax Practice of PwC. And to his left is one of my colleagues, Gretchen, an international tax partner in Deloitte's Washington National Tax Practice. As I said, there's two international panels in the conference. The second panel is tomorrow. Our panel is going to focus on more Section 385. It's a big deal, so warrants the additional attention. Section 367A and D, the U.S. Model Treaty. I'll talk briefly about Brexit, and time permitting, we'll be talking about some potential international traps in international M&A. So with that, let me turn it over to Mike.
Thanks, Neil. So the first thing we're going to talk about very briefly is there's a new set of regulations that just came out final. So we got a surprise. They were released while we were on our way here, so we can't say that we've been through them in any detail whatsoever. However, we did quickly look at them so we could say a few things about them. Just to set it up quickly, the reg package is a 956 reg package, and it actually had, I'll say, two ways of looking at 956 investments through partnerships. The first reg was a temp and proposed reg that looked at the 956 investment. So this is if you have a partnership and it has investment in U.S. property. And when you were looking at measuring the amount of 956, it was triggering off the amount of distributions that were coming back. And that was, I would say, very consistent with what the New York State Bar had recommended be done with 956 and sort of the questions of loans to foreign partnerships. The other approach was a proposed reg approach, which was much broader, harsher, and it was just to treat it as an aggregate and sort of just ignore it, and then you would have 956 regardless of the distribution. So when we got the new reg, I guess the race was, which way did they go? Did they go with the temp reg, which wasn't as harsh as the proposed reg, but seems to be working and accomplishing what the government wanted, or did they go harsher? And I guess I'll turn to Joe and Gretchen and what our quick thoughts are on that.
Yeah, just from scanning that reg package, it appears that they went to the harsher approach. So if you had a CFC making a loan to a foreign partnership, and let's say the CFC's U.S. shareholder was a partner in that partnership, so you had the related party relationship, it appears, based upon a preliminary reading of those regs, that the U.S. shareholder is going to have a 956 inclusion as a result of that loan because of an overall general aggregate approach that was adopted in the final regs, which was consistent with what Mike pointed out in the proposed regs. The temporary regs really would, in determining whether you had a 956 inclusion, would have looked to see whether there was a distribution to that U.S. shareholder that wouldn't have been made but for the funding by the CFC to the foreign partnership. So based on scanning these regs before we came over here, it appears that the aggregate approach of the proposed reg has generally been adopted in the final reg. And I don't know, Gretchen.
No, I had the same thought. So the proposed regs, the temp regs took more of a tracing approach. You had to actually show that cash came back to the United States, came onto U.S. shores, and it looks like in these final regs they went with an aggregate approach that just looks at whether there's a 956 asset sitting in a partnership with a U.S. partner with the related CFC partner, as opposed to actually requiring that the money come home.
Yeah, and one other point of the proposed regs that one other item that the final regs didn't address that personally I was hoping they would you could have a U.S. shareholder where you might have multiple CFCs guaranteeing a loan of a U.S. shareholder. Let's say that loan is for $100. Third-party bank gives a loan to a U.S. shareholder of $100. Multiple CFCs with earnings and profits guarantee that loan. Under a strict technical reading of the regs, if all of the CFCs have sufficient EMP, you could have an inclusion greater than $100 under a technical reading of the current regs. IRS and Treasury got a lot of comments about that rule, saying, hey, draft a rule that will somehow prorate that so the shareholder wouldn't have in excess of 100. And from reading through the preamble, it appears that they didn't squarely address that. They're still considering it. So I was hopeful that they would address that in that reg, in the final reg, somehow do a proration, but they didn't.
Okay, so we will study that more, and I'm sure you'll hear about it in some other panels in the near future, because it will be one of the, certainly if you're going to go to GW or some other conference, people will have more time to get into the regs, but we just wanted to give everyone a heads up on that. Okay, so now to our actually scheduled program. We have a number of things we're going to cover. We are going to cover the 385 regs. We're going to cover 367. We're going to cover some treaty issues and a little bit on Brexit. And then we have some catch-all about some traps and stuff. I actually don't anticipate we're going to spend a lot of time on that. We'll get to what we can there, but we are going to give some time and attention to the 385 rules. Now, I'll begin by saying these 385 rules had everyone's attention because they changed the entire landscape for all taxpayers. And they were dramatic, they were shocking, and everyone was from, the practitioners to taxpayers to people on the Hill were really concerned about the rules. And Treasury did not receive a lot of favorable comments about them. They did go ahead and finalize them, but unlike 956 with going with something harsher, they actually cut them back substantially. And what they did is they sort of brought them back to their original intended target, which was largely inbounds, although their stated target was inverted companies. I think these rules are actually meant for a lot broader group than just inverted companies, and they are really were originally targeting all inbounds. But there wasn't a practical way to do that with the tools they had. So you sort of saw this development of these 385 rules, and what we're going to go through is some highlights on them. The corporate panel is going to go through them and talk about some other pieces of the regs that we're not going to cover.
Already did.
Already did. There you go. Sorry. But we will hit some of the things that we think are important in considerations. Now, while I say they are inbound focused, they are still relevant to outbounds. And there are some things within the regs that one needs to worry about because they've reserved on an expansion of the regs. And if they do expand them, it could become, a huge issue for everyone once again. So to highlight, the new regs, which are in part final and in part temp and proposed, which I think was a prudent way to approach this, which means they've got 3 years to modify it, the temp pieces, which is a -3T and 4T pieces, and do some more, they can do some more modifications. And hopefully they will to clean some more things up. I guess maybe I'd hope they'd pull the whole thing, but maybe that's not going to happen now. So starting with the big point is it only applies to domestic issuers with some exception. We'll get into that a little bit as we talk here, but one example of that would be a partnership where they've again applied an aggregate approach. So if I have a foreign partnership that is the issuer of the debt, it'll apply an aggregate treatment, and there we have application of the rules, the -3 rules, but interestingly, not an application of documentation rules. So you can have situations where it's not picked up in documentation, but it is picked up in the 3T rules.
And vice versa.
And vice versa, exactly.
His short-term debt is better off under -3 than -2.
That's absolutely true. So the rules do require documentation. This is something that I do think U.S. multinationals have to worry a lot about because it does, while there are exceptions to trade receivables and other types of things in the -3T rules for recharacterization, there are not those exceptions in the -2 documentation rules. So you can have the documentation requirements even though it's not subject to recast under -3T. And then they do get at what I'm going to just say is sort of a per se category of ways, easy ways, that foreign multinationals have been able to put debt, or any foreign investor, it doesn't have to be a foreign multinational, because again, these don't just apply to foreign multinationals, are able to put debt in place. Now, the rules themselves, 518 pages of, well, not regs, but a 518-page package, most of which is response to comments. And even with 350 or so pages of responses to comments, I will tell you they didn't respond to all the comments, because there's still some things that I think were uniquely placed with some comment letters. For example, the interaction of the new 385 regs with the newly enacted 897L, which is an exemption for foreign pensions on FERPTA, and how you can run models, and this new 385 change can actually undo the advantages that foreign pensions would have had in making infrastructure investments in the U.S. So there's this general, well, there's some specific industry things that we looked at but aren't going to reply to. But I think there's still some more conversations to be had about sort of right-sizing the scope here. So, and hopefully those things will happen in the next administration. Okay, moving to our next page. Sorry. There we go. Okay. So just to highlight the framework of the regulations themselves, we've got the general definitions in -1. Really important here, they removed the bifurcation rule, where they could take a single debt instrument and break it up into debt and equity, however the examining agent might see fit. And then the taxpayer would have to argue with that. That really put a taxpayer in a difficult position and was contrary to all of our established jurisprudence. So they abandoned that approach, thankfully. So that is a big change, a very important change. Moving on to -2, the documentation, I would say, is something you spent a lot of time on with your earlier panel, but it's an important provision. It's something that is going to require a lot of attention, not just for inbounds, but for outbounds, to make sure the documentation is in place. Because if you miss the documentation, you still can have a problem. Now, there are some exceptions, but you can have a problem with its recast. And then the last, well, I won't say the last, but the next two provisions, the -3 and -4T regs, the -3T are the one where we spent most of our time worrying, which was the recast provisions. That, again, has been substantially narrowed by only applying to U.S. issuers. And then we have some rules that apply a single entity concept to consolidated groups in the -4 rules. Okay. So, effective dates of the regulations we've got here. This was another big change. So when you look at these changes, they are significant, and taxpayers were very worried about the retroactive effect of them and the ability to actually comply with the documentation rules, for example, where you had 30 days to get the documentation done. Now, if you have the systems in place, that might all be pretty easy to do, but taxpayers really weren't going to have the systems in place to do it. So right now, when you look at the timing, for example, on documentation, you're not going to see it show up until, if you're a calendar year taxpayer, until 2019.
Yeah, and we should talk about that just for 1 second, because there's an interesting example in the regs. I think it's example 1 in the documentation rules. So, there can be a misconception about when it is people need to start worrying about their documentation, and this can apply for inbounds and obviously outbounds on their 956 loans. And it's not that you can't pay attention to this until September of 2019. Maybe for the documentation you can, but in order to prove creditworthiness, the examples are very clear that you have to establish the capacity to pay and do your debt capacity analysis as of the issuance of the instrument. And that happens in 2018, right? So I just want to make sure that people are focused on that, because I have had some clients sort of react by saying, well, we don't need to worry about this if we're calendar year until September of 2019. And it's like, well, on the documentation piece, yes, but not on the debt capacity studies and the like. So that's a trap potentially for the unwary, particularly because the scope, as Mike alluded to in -2, is fairly broad. I mean, I think the fact that it covers accounts receivable, accounts payable, there are a lot of accounts payable and receivable that cross borders where there's a U.S. issuer, even for outbounds, that folks don't necessarily have the best hygiene around. So, sorry to interrupt you.
No, not at all. And then looking at the general regs themselves, of course, the major transactions they're worried about were like the issuance of a note, which bothered them because it was so easy to put debt in place by issuing a note, something that's been with us going all the way back to the 1950s, if not before. That was the first time it was challenged in court, and the government lost, as they should have, because you can sort of explain economically it's a dividend, and it's property, and it just happens to be a note rather than cash, and then cash loan back. But it was pretty easy for companies to adjust their debt levels. They didn't like that. And so they've made that per se and stuck with that. But then we'll go through some of the other transactions, which are pretty easy ways to put debt in place, and they don't like those either. And so they've stuck with shutting those down sort of with that original date. There is some nuance in the transition rule when you get into it, and there are some circumstances where I would say they've almost tightened the rule more than it was in the proposed reg as they sort of ratcheted down here. And they might have felt more comfortable doing that once they just focused largely on foreign multinationals, that they had a free hand to sort of tighten the rules a little bit with effective dates. So with that, we will then move to the documentation rules, and Joe.
So, as Mike pointed out, the taxpayers covered by this specific rule has been scaled back quite a bit. You're generally talking domestic corps, but certain corps are carved out, like S corps, non-controlled RICs, REITs. As Mike pointed out, if it's a foreign partner, or if it's a partnership, debt instruments issued by partnerships generally aren't covered. However, there is an anti-avoidance rule in there if you're doing something backdoor. So the type of taxpayers covered by the documentation has been scaled back. And I'll say this, and this may be a point to make, is even if you're not in the -2 rules, it's probably good to follow them anyway, because documentation and what we're going to talk about is important in just general debt equity analysis long before these regs came out. So that's something to think about. As far as who's in the rules, it's generally if a member of the group is publicly traded, group assets exceed 100 million, group total revenue exceeds 50 million, you can be in the rules. If you're in the rules, as Mike pointed out, the general rules, if you don't do the documentation that's required, subject to certain exceptions, the debt will be treated as equity. Now, with that said, if you do the documentation, it doesn't mean per se that you have debt. It just means that you've satisfied the prerequisite to be debt, and then you would apply the normal factors that go along with that. You look on here, these are the basic requirements that you're required to satisfy for the documentation rules. Unconditional obligation to pay a sum certain, holder's rights as a creditor, issuer's ability to repay the loan obligation. That goes to credit analysis, ensuring that you have done some type of credit analysis to support the loan. Issuers and holders' actions evidencing a debtor-creditor relationship, such as payments of interest, etc. And I think as Gretchen pointed out, these rules do kick into revolvers, cash pooling. Now there are some easing of what you have to do to satisfy these requirements in these regs compared to the proposed regs. Like for instance, they could, under master agreements, they could allow a single credit analysis may be prepared and used on an annual basis for group instruments by a member up to an overall amount of debt. So they have alleviated some of the you still have the requirements, but they've made them maybe a little less harsh.
Let me just, so I think an important takeaway is that this entails a process that involves more than tax. It's a question of inventorying loans. It's a question of educating people in your treasury function, people who are responsible for making loans, that they know to coordinate with tax to make sure that there's no problems in the documentation. Right? It might involve systems changes to deal with the documentation and to alert the right people in the organization. So even though there's an extended effective date, this is something that you probably want to focus on sooner rather than later. And I'll point out one other thing, that even though this is the international panel, these documentation rules could theoretically have a pretty big state impact, because even though these regs attempted to fix the state problem, if a state doesn't buy into the consolidated return exception, then you may have, these rules may find applicability far beyond what really contemplated.
Yeah, and going back to that point, even if you're technically not in these rules, you really should almost think of yourself as being in them, because it's just a good practice in substantiating something that you intend to be debt. Some other rules here, as Mike pointed out, there's an extension of the period required for timely preparation. Under the proposed regs, if you issued a debt instrument, it generally had to have been documented within 30 days, certain interest payments within 120 days. What these rules do in the final regs is they push that back a little bit, so you could satisfy this requirement if it's prepared by the time of the issuer's U.S. federal tax return, including extensions. So they give a little bit more leeway in these regs compared to the proposed regs. The rebuttable presumption, this is another good development. Under the proposed regs, if you had an undocumented debt instrument, it generally would be treated as stock. Now, the way this rule works is if you show a high degree of compliance, and the regulations kind of define what that is, and it's some tests where basically you're getting everything right. You may have missed something, but you're basically a high percentage of your instruments are documented correctly. If you do that, a taxpayer can rebut the treatment as stock by clearly demonstrating sufficient common law factors showing that it would be debt. There's also a reasonable cause exception in there. There was also one in the proposed regs. The delay in implementation, they apply only to debt instruments issued on or after January 1st, 2018, so it gives taxpayers, as Neil pointed out, more time to get their systems in place, their documentation approach in place. But this is something you should really be thinking about today if you're issuing any type of debt instrument. Certain industries, they have not exclusions, but if you satisfy certain regulatory requirements, it'll be treated as satisfying the documentation requirements. So that's a relatively good development. Now we go to the debt recast rules, and Mike's already alluded to this, and unless an exception applies, under the -3 rules, you can have certain debt instruments, even if you satisfy all the documentation requirements, being treated as equity rather than debt. And the types of transactions they're looking at are ones that quite frankly, the IRS and Treasury target it. For instance, we have some examples here, note distributions by a U.S. company, let's say to a foreign parent, using a note in a related party 304 type transaction, using a note to effectuate essentially a cash D, using a note instead of cash. Those are the types of transactions under the general rule where even though you might otherwise consider that good debt because you satisfy all the documentation requirements, that note could actually be treated as stock under the general rule if you do that, assuming no exception applies. And we're going to walk through a number of the exceptions that can potentially apply to either eliminate the recast or mitigate it to a certain degree. There's also a funding rule, which basically is designed to say, well, you're doing in 2 steps what you didn't do in 1 step. So if you distribute a note, that could potentially trigger the funding rule. Well, what if you get a loan from, you get the cash from a related subsidiary via a loan, and then you distribute the cash? That's the kind of 2-step transaction that the regs are designed to get at under the funding rule. So you can see here the purpose of the rule, and this is the IRS's, that these type of transactions induce leverage but not capital into the expanded group, and that they lack meaningful non-tax significance. I disagree with that, but that's their articulated reason for the -3 rules, which in my humble opinion are probably on the outer edge of what one would say authority.
We should talk about that, yeah. So there's an argument that the rules are not consistent with the statute. Now, they may or may not be, but there is, I don't think, a lot of debate whether they're consistent with OECD principles, where when you look at debt, generally it's looking at limiting the amount of debt. These rules caused the debt to become equity per se. And that is very different than limiting the interest deduction, because it has these follow-on consequences. When it becomes equity, then you start having, when you pay it off, you have redemptions, you have, it just totally changes all the consequences. You create these hybrids, which seems odd, considering BEPS. It does a lot of very strange things. And so from a policy perspective, I think there are a lot of questions. Now, I know Treasury was very worried about inversions. I would say they didn't need to be. They already wrote rules that went well beyond anything that was envisioned with 7874 to shut down inversions. But they put these rules out, and they're very powerful, very troubling, and they've got a lot of significant consequences that raise some real questions, and I think will continue to raise some real questions going into the next administration.
Yeah, and I think one thing that's really important to note here is that, as you were talking about the funding rule, Joe, the breadth, the overbreadth of the proposed regs still sort of, in many ways, the source of that overbreadth continues in these final regs, in that the funding rule fundamentally looks at transactions within a 72-month window, 36 months before and 36 months after. You look at all the prohibited transactions, 36 months before, 36 months after the issuance of the purported debt. And they didn't change, they didn't tighten that period, right? Many people expected that period to be, tightened to a year before, a year after or something. They didn't change it from being per se to being sort of a rebuttable presumption. So they didn't do some of the more underlying things that were causing they didn't fix some of the underlying things that were causing the overbreadth. Instead, they decided to address it by having some exceptions to the types of debt, to the amount of time that the debt is outstanding. And when we talk about some of those exceptions, you'll see they're a little clunky and they're imperfect, and that will mean that some people will still get caught up in these rules.
Yeah, and we talked about traps for the unwary, which we might not be able to get to, but we're actually going to get to them in the funding rule, because that's one where you have change at the company with people. They decide to distribute a distribution, and all of a sudden you could trip this. And it is certainly, you look at the documentation rules, you might say, well, okay, third-party lenders, when they do loans, that creates more of an administrative burden. But this, the total recast, even though everything else would point to debt, is really a significant step, and maybe an overstep by the IRS.
Treasury, yeah.
We have a question in the back. Can you speak up? Sorry, I'm sorry, we just can't hear you. Okay, great.
That if a debt instrument, each job was issued among members that were members of the state, and the recast occurred, is there a potential for a recast if the group slipped out of each job's tax? Was that pool, I remember that correctly, and was that pool retained in the current tax? That is, recast and it would slip out of each job's tax, you would be able to get back to that.
Oh, so your question, just to restate the question so everyone can hear. So if I have, let's say, a situation where, let's keep it simple, I issue a note as a dividend to my foreign parent, and then my foreign parent sells down the stake in the U.S. group so that it's no longer part of the EIG, the expanded, or the EAG. And the question is, does that then cause that equity to flip back to debt? I don't think so.
I just don't recall.
Yeah, I don't recall.
There is a retesting that occurs when you leave the, the EG, when you leave the consolidated group, and I just can't remember if it goes back.
and there
Or
are-
it only goes one way.
There are rules when you come in and go out, but to be
I
honest
think,
with you, I don't recall.
yeah, but I think the characterization occurs at the time you have the per se event, for those per se characterizations. And I don't think there's anything in the reg that pulls you back out, but that's an interesting question. I haven't really thought about
I think it is in the consolidated under the dash.
Under the
In Dash 4, there are rules that provide that once you leave the consolidated group, you can have stuff that, like, let's say it's a U.S. to U.S. loan that was disregarded, and you come out of the consolidated group, one leg of it, it will become
Yep.
equity. It'll be tested. I just don't recall if it goes the other way. Neil, do you?
I thought it did.
It might.
Okay. Still learning. Okay.
I think Gretchen?
We're going to go to the exceptions.
Yep.
So, as I sort of articulated a second ago, the way that Treasury decided to deal with the overbreadth in these regs is a series of exceptions to their scope, fundamentally being that they did a very generous exception for all foreign issued obligations. I think many of us had heard that there would be an exception to foreign debt. I think we were all a little surprised when it went further and did foreign issued debt. So the only thing in scope is U.S. issued obligations. And then there are some additional exceptions for regulated industries and the like, which we'll cover at a high level. There are, in addition to sort of these big picture exceptions, there are certain exclusions for subsidiary stock acquisitions, stock-based comp and the like, which we'll talk more about. And then there are these reductions. So there are these three categories, if you will, of things that are rules in the regulations that can reduce the impact of the 385-3 recast rules if they otherwise would have applied to you. So if you had a U.S. issued obligation. So you have a general exception and exclusion, or some other sort of reduction of the amount of your debt that would be recast. In terms of these general exceptions, I think the first category is certain debt instruments are just out of scope. It has to be a covered member. A covered member is only a U.S. Corporate issuer. It has to be debt that's issued before April 5th, 2016, so that grandfather is retained. Debt issued or acquired by a dealer in securities and their capacity as a dealer is out. Debt issued by certain exempt regulated financial companies or insurance companies are out. These industries were very forceful lobbies indicating that there's lots of reasons why they have debt that they issue in their ordinary course of business, and these aren't the sorts of transactions that lead to the base erosion that Treasury was worried about. And those rules are fairly complex and very particular to that industry, so we won't go into them in depth here. There are a series of exceptions for certain types of debt instruments. These are in the temporary regulations, presumably because there's a lot more detail here than was in the proposed regs, and so they're looking for additional comment to more finely, tune them or hone these rules. And there are a couple categories of these exceptions. One is certain short-term funding arrangements, and we'll talk more about what we mean there, but basically short-term debt that's in place to deal with certain liquidity concerns. Debt that's in place because it's an ordinary course loan. So loans for goods and services, or for goods, excuse me, mostly, issued for goods in the ordinary course of business, so long as the debt is expected to be paid off within 120 days. They also made clear in this package, relative to the proposed package, what was initially what was interesting about the old ordinary course exception is that it provided for an exception for goods issued for services, which had us all a little puzzled because the debt recast rules in 385-3 can only apply when you issue debt in exchange for property, and services and royalties and leases shouldn't be thought of as property in the traditional sense. And so they've made that clear, that the scope of the ordinary course exception is more narrow because the scope of the general rule is more narrow, and they've sort of right-sized that. Something that I think a lot of us clamored for, they have provided an exception for interest-free loans. I mean, one of the big policy questions in this regulation package overall is, what are we after? What is the point of these regs? And as you know, as Mike alluded to, historically we've been concerned about providing interest deductions when they otherwise aren't appropriate. And so one of the things that was truly puzzling about the proposed regulations was the amount of complexity and collateral consequences that were being caused with respect to debt instruments or purported debt instruments where there was no interest that was being charged, no interest that was required to be charged, imputed or otherwise, or required under 482. Why were we turning corporate structures up, on their heads for no understandable sort of policy concern? Was it really that we were just worried that the repayment of principal was fundamentally different than the repayment on equity, or was it really that the breadth was too large? And so here, what's really interesting is that you see a series of short-term debt exceptions in the debt recast rules, where it seems like the regs are getting more, finally sort of honed on what I think should be the policy concern, which is, interest deductions that are being provided in instances where we have some concern. What is odd is that you don't see that same type of honing of the documentation rules. So, you're going to have AR and AP that may, or, accounts payable that are outstanding for short periods of time. There may be no stated or required interest, and yet we may have things that may flip to equity just because someone hasn't documented them. And does that make sense to us? So that's, I think, a remaining policy question that's more a -2 concern, but has been reflected here in -3. And why do we have these disparities between the documentation rules and the debt recast rules is not really clear to me.
And to pause on that, they finalized the -2 regs.
Yeah.
So presumably they are done.
Yeah.
And they're not going back on that question.
Yeah.
But I really think.
And these are temp.
Right, and these are temp, right, but the documentation's not. And there's a number of things I need to go back and think about. They rushed these out. We were all in government.
Yeah.
They rushed these out. And so, hopefully, just because something's final doesn't mean it can't be changed. So
harder, though.
But they could just write a new, they can write a notice. It's really, pretty. In fact, the next administration could write a notice and say, the Treasury will not apply these regulations. So you can have changes, but yeah, you got to go through the proposal of proposed regs coming out and then make the change over time. But hopefully they will go back and fix some of that, because it doesn't make a lot of sense.
And it isn't, to their credit, this is a tremendous package. The amount of work that was put into these regs is extraordinary. I can't imagine during my tenure us being able to get it out. So there's also an exception for deposits received by a qualified cash pool header. There were lots of comments, obviously, about cash pools, and that these loans, again, weren't things that typically had stated interest. They weren't they were just dealing with short-term liquidity issues. There's an exception there. There's a threshold exception for the first $50 million of debt instruments. That's no longer a cliff. It is truly an exception. I'm going to skip the next slide that just restates the exceptions with a little bit more detail because we're running out of time. There is an exclusion for subsidiary stock. Importantly, they recognize that the regs fundamentally are, especially the funding rule, are concerned about when you're injecting leverage into an entity and then you're quote unquote defunding it. And you're moving that additional operating capital out through some sort of transaction. And so they recognize that to the extent you're just buying subsidiary stock, you haven't been defunded at all. In fact, you just have moved it down a tier, and that value sits in your equity. There are important exceptions for stock issued for compensation for services. It doesn't matter which way, there are a couple ways that people do this. Some people actually have their CFCs pay for parent stock to provide equity compensation to their offshore employees, or vice versa. And in some instances, it's unfunded, right? There's just a deemed transaction and a deemed contribution of the cash needed to buy the equity. Regardless of how you do it, all equity compensation is off the table. Any distributions, acquisitions as a result of transfer pricing adjustments, so we're talking about secondary adjustments as a result of either a taxpayer-initiated or an IRS-initiated transfer pricing adjustment. Any of the secondary ramifications are off the table as causing a problem under these rules. Similarly, they provide that the deemed payable and receivable that can spring to life if you elect into 9932, Rev Proc 9932, in order to deal with those secondary adjustments in a either taxpayer-initiated or IRS-initiated transfer pricing adjustment are off the table. What I do see with clients is that there are a lot of folks that just deal with, forget about an adjustment, just doing true-ups and the like. They tend to have AR and AP that hits their books at the end of their taxable year in order to true up transfer pricing. That is not out of scope. That's just normal AR and AP and can still be included. And then really importantly, there is an exception for this quote-unquote cascading problem. As we all saw, particularly when it came to cash pools, once you had one instrument turn in from debt to equity, it looked like the cash pool was buying equity for cash, and then that caused other equity, or sorry, other debt, excuse me, to cascade into being converted into equity. They stopped that. You have the first recast, and then it stops. And then I'm going to now turn it back, I'm not sure who, to talk about the reductions.
I think that's right. Yeah, so the two I'm going to talk about, one is the EMP one and one is the net equity one. The EMP one, in the proposed regs there was an EMP one, but it was limited to current year EMP. IRS and Treasury received a lot of comments, well, why just limit it to current EMP? So the new rules expand the scope of this rule. It includes all EMP of a corp that was accumulated while it was a member of the same expanded group and accumulated after April 4th, 2016. There's some special rules. If there's a change in control, there's some special rules in the consolidated area. This rule applies before the rule dealing with capital contributions. So in this sense, they've expanded the scope of the EMP exception, which is a good thing. There's also a rule for net equity. This is a new rule. This wasn't in the proposed regs. And this rule essentially provides an exception pursuant to which certain contributions of property are netted against prohibited transactions. So once again, as Gretchen pointed out earlier, they didn't get rid of the -3 rules, but they've added some new exceptions which maybe alleviate some of the impact of these rules. If you could pass me the so there's some details here on how the EMP exception works. I'm not going to spend a lot of time on that. It's worth noting, though, they've expanded this exception from the proposed regs. It's likely going to be more available to utilize to offset the impact of a note distribution or a 304 type transaction. Here's just an example of the qualified contributions. Once again, this is a new exception. It provides a little bit more ability to offset the impact of the prohibited transactions. I know we're running a little slow on time, so I'm going to turn it over to Mike to go through some illustrations, visual illustrations of the type of rules that the -3, what the -3 rules are getting. And I guess we're going to have to assume none of the exceptions apply in a lot of these examples that we've been discussing.
Yeah. So, we've already hinted at it. The first one that they went after goes back to Kraft Foods, an old case, I believe, from the 1950s, like 52 or something, or right around the time 304 was coming into being. But if a corporation issues a note that is a distribution of property and it was just treated as a dividend, and that's been black letter law ever since. It was probably what people understood the rule to be before it was litigated. And why is that? Now, I know in a lot, for some time, inbounds were facing a lot of scrutiny with exam teams. Exam teams were looking at, and they said, well, this is suddenly appearing debt, or, it just spontaneously appearing debt. It's not. It's actually, you've got earnings and profits, you're making a distribution of property. Rather than distributing cash, and then the foreign parent making a decision to perhaps reloan that cash, you just issued a note. And these rules make clear that when you do that, that's equity. That's equity out of the gate. However, the rules also make clear, by narrowing it to only U.S. issuers, that when I have, certainly when I have that happening up above the U.S. structure, foreign to foreign, not a big deal, or brother sister over, not a big deal. But it's also not a big deal when it's coming from a CFC. So that's where indebtedness is not recharacterized. So if I have a foreign issuer, I don't have the recast.
Yeah, so the right-hand side was bad under the proposed regs, but now it's...
It was, right.
Now it's good.
Now, it was bad under the proposed regs. When you look at that from a policy perspective, what are they getting at? U.S. base erosion? No. What they were getting at was repad, or they were getting at other things. I mean, these 385 rules became much more than what was said about them in the Rose Garden. It was getting at credit hyping. It was getting at repatriation transactions. They were getting at everything, and they've cut back from that. And so the regs are now more focused generally upon base erosion with debt. And the place they're concerned about that is where you have a base erosion with debt from an investor outside the U.S. And so that's why it's looking at a U.S. issuer. So the one on the right is okay, the one on the left is still bad. Moving to the next, and I'm going to go through these a little bit faster, just other ways of putting debt in place. You could have a B reorg similar to the acquisition of shares for comp. You could acquire shares that are used in a parenthetical B or a triangular B by issuing a note to acquire the shares, or issuing debt to acquire shares. That is, again, something that's bad. Now, I would say that was already somewhat policed by the 367B-10D rules, but you might have those rules not apply because it's actually equity under these rules. But again, if you have transactions moving over to the right that do not involve a U.S. issuer, you're not captured by the rules. The next one is really just another, let's see, oh, we removed it, okay, sorry. The next one is, whenever you think of different ways of putting debt into an acquisition, your triangular Bs, could be in the internal context. You could do it with a 304 transaction. It's the sale of shares, where the target is not disregarded as a result of the sale transaction. That is another transaction where, if done with a U.S. issuer, is bad. If not done with a U.S. issuer, it's okay. And then the next one is just a D reorg, which is really the same as the 304, except I generally check the box. And again, they're getting at that in the case of a U.S. issuer. So they're getting at what would be the blocking and tackling ways of multinationals or other inbound investors of putting debt into their structures as a result of acquisitions. It's not to say you can't have debt, though. You can. It just needs to come in a more common way. That is, you have to contribute it, the cash, and take the note back, and then that's okay. But you can't do it through these mechanical ways of sort of putting debt in place.
So in this example, Mike, basically this was covered under the proposed reg, this is a repatriating, cash D. So
Right.
that survived. This transaction has survived the final, I guess, temporary.
Yeah, again, bringing the regs back toward the, a little closer to what was said in the Rose Garden about them. They were really getting at the base erosion and not everything else they were actually getting after in the proposed form. So they've reduced them substantially, which is I'm not going to say is a gift back to the taxpayers, because I think it was completely inappropriate to use 385 to do all of that, but it has made life better than it could have been if they had gone forward with the proposed regs.
So go back one example. So, go back to another example.
You want the
304. So the other transaction that's noteworthy that survived is the foreign to foreign 304 transaction, which is used in international planning to, hype your pools and, create deficits with the debt, and so those transactions.
Or to monetize your investments and avoid withholding tax or do other. I mean, at times you can say 304 transactions have been blessed by the IRS as ways to get cash back from their foreign investments. In fact, the 965 notices did bless that. They said, all right, you're going to bring back cash for 965 with the elective repat. We're not going to force you to face withholding taxes if you can plan around them. That's actually a good thing for the U.S. Fisc because they would be creditable if you paid them. So yes, it does back off that.
So let me ask you this question. Is the government going to circle back and take another look at shutting these transactions down? I know they had to issue these regs in a hurry because
I worry about that. I worry about that a lot. I think that, when I've heard Treasury talk about why they reserved on foreign issued debt, they will say that they are not currently working. They'll leave that to the next administration to think about. But they describe it as sort of a cost-benefit analysis, as thinking about the tax policy concerns that they had about intercompany debt, certain intercompany debt in a foreign group, and the collateral consequences that having those foreign issued obligations be subject to 385 resulted in, and they thought that balance was off. But they said, we still have a U.S. tax interest in those instruments, and we think that there are nefarious things that can happen with those instruments, and to my mind, I think that's government to speak for. We might be thinking about doing something else on repat before year end.
Yeah, the interesting thing about this, when the proposed regs came out, when the first proposed regs came out, one of the things that hit me is you have had Green Book proposals trying to address cash D type transactions, leverage distributions, and when I first read the proposed regs, I almost thought of them as, well, this is a way of attacking, at least to the extent you're using a note, certain types of transactions that couldn't be addressed, at least congressionally.
Yeah, they knocked off their wish list of everything government wanted to do, and I wouldn't say every government's wanted to do. I think it's just under this administration, there's a number of things they had signaled through Green Book proposals they wanted to do. So it is, when you look at the regs, it says, U.S. issuer, and then there's reserved. So it's pretty easy for them to insert something more. But where the proposed regs was way too far, no question about it. I looked at it for sovereign clients, and the rules would make them not foreign governments because you started looking at these cascading consequences, and all of a sudden they don't qualify for foreign government benefits, and you're like, what? This is crazy. Or you start looking at the due diligence you'd have to go through and looking at, you're going to acquire a French group of companies, and, what did they do with their debt? So it was way too much. I thought maybe they come back to a relevance rule of sorts, stick with CFCs still being bound in some way to the rules. They didn't do that, fortunately. But again, if they had done that, they would have been going well beyond what they were really trying to get at, or what they said they were trying to get at, and it just became this whole add-on of a whole lot of other things they started jamming into these regs.
Yeah, I want to answer the question that we got, I think from your brother, actually, Neil, back in the back row. And it's not in -4, it's in -3. There is a rule. -4 deals with people coming in and out of the U.S. consolidated group, but there is a rule that provides when you have one end of the transaction leaving the EG, it gets retested such that it can come back to being debt from being recast as equity. So there's a deemed exchange.
Okay, we got 15 minutes?
Yep. Who's next?
You are. Yeah.
Do we want to go to 367D or treaties?
You want to do the predecessor rule?
Oh, the president,
yeah,
yes, I
yeah.
do. I do want to do that.
Predecessor rule.
So, sorry. So one of the things that I think, we've thought a lot about is where do outbounds have to be worried? I think the impact on inbounds is fairly clear, but the question is, what about outbounds? Can they, with the exception of having to document 956 loans, can they otherwise kind of fall asleep and not worry about this, with respect to 385? And I think there are, as I articulated, some sort of traps. And I think one of the things to think about is what's at stake. If you decide, some folks have said, well, we're just going to ignore this package. We think the whole thing is invalid, and we're going to ignore it. And validity questions aside, which I think may be real, the impact of a 956 loan, for example, getting recast can be pretty severe. So one is you will have U.S. equity, and you will have a 956 investment with no exceptions, where you might have some exceptions for short-term debt, depending on whether it's for goods and services and when it's paid off and the like. The second is that your withholding tax consequences could be vastly different. Our treaties provide for a zero rate of withholding on interest pretty uniformly. There are some exceptions in the network, but not many. And that's quite the opposite when it comes to dividends. So the withholding tax, the 956 consequences can be pretty significant if one of these things flips. So I think we understand sort of what that means, what you have to do to prevent that in the 385-2 documentation rules. But when you look at the 385-3 rules as an outbound, I think one of the first things you ask yourself is, well, aside from doing, when will this ever arise for me? When will I have either a general rule transaction or a funding rule transaction, or otherwise known as a prohibited transaction, that could otherwise cause my debt to be flipped to equity? And I think it's a good question. And one of the places where this can happen is as a result of the predecessor and successor rules. And these rules are relevant for inbounds too, but I kind of wanted to focus and wake up the outbound people in the crowd, because this is when I think you all need to pay attention. So the predecessor and successor rules basically are telling you, sort of big picture, that if a funded member has a transaction with a related party in the EG, their history of prohibited transactions in the context of a predecessor, or what the successor does in the future, can give rise to a prohibited transaction for the funded member or the U.S. person that's been an issuer with respect to an obligation that's in scope. And so as a general matter, on the predecessor side, you need to be worried. You can have a predecessor when you have a 381 transaction or where you have a 355. So for outbounds, think about CFCs coming inbound in a liquidation, for example. With successors, it's 381 transactions, 355s, as well as, which I think most people have missed this, as well as instances where you're funding, where you're making a contribution. So you have a U.S. Member of your U.S. consolidated group, it's got a 956 loan that's covered, and they make a contribution to a CFC, that CFC is now that U.S. member, that U.S. issuer's successor. So what happens? What's the bad thing that can happen to you if you have one of these predecessor-successor transactions? So I did this as an outbound example because, again, I think outbounds haven't focused on this. So again, we see here we have a U.S. multinational. It has 3 CFCs, 2 in one chain and 1 in the other that's brother-sister. You have a 956 loan from CFC 1 to the U.S. parent. U.S. parent then makes a cash contribution down to CFC 2. That makes CFC 2 a successor. That transaction is not a prohibited transaction because they're acquiring subsidiary stock. So that in and of itself isn't a prohibited transaction that flips my 956 loan to equity. But I now have a successor in CFC 2. What's surprising about that? I think this caught people a little unaware initially when they were reading the regs, because I think when you thought about these regs, because they did a foreign issuer exception, I think a lot of us thought, oh, there's like a water's edge kind of approach here, and we don't need to worry about -3 with respect to our CFCs, but that's not true. So as long as you have a U.S. issued obligation, you do need to track prohibited transactions in your foreign group in certain circumstances, and this kind of happens all the time. Remember, one of the first comments we made is that the funding rule is still overly broad. There's a 72-month window before and after this 956 loan. So of course you'll have a 956 loan from one of your CFCs, potentially short-term, to your U.S. parent, and then a contribution down. So now what that means is that we need to be very careful about our short-term debt exceptions for that loan, right? And make sure we don't run afoul of one of those exceptions. Or if we have a structural 956 loan, let's say we have PTI and we just are keeping that 956 loan around, then we won't have one of those exceptions, and we need to really pay attention. And so we're going to have contributions down to a CFC. Sure we are. That's going to happen all the time within a 36-month window. And then when that CFC, and this is where the prohibited transaction comes up because of a glitch currently in the regulations. So let's imagine that CFC2, the acquisition of that entity's stock is not a prohibited transaction, but it did make, as I said, CFC2 a successor. So now I have to worry about its prohibited transactions. Well, CFC2 then makes a capital contribution down to CFC3. Policy-wise, I would have said that should also be accepted, but that's not the way the rule currently reads. And the reason why is that the regulations today have the exceptions key off of when you are a covered member. And the only thing that a covered member does not include today in the regulations your successors and predecessors. The term that includes your successors and predecessors is funded members. And so this second transaction, while I think policy-wise should not be a prohibited transaction, certainly not in the spirit of the rules, it is in fact a prohibited transaction. And so you would flip this loan to equity if you don't otherwise have an exception, like a short-term debt exception that actually applies to you. So there can be traps here, and that's the point that we were sort of making, that people need to pay attention, even outbounds.
So the next topic is one that could impact a lot of people who do outbound transfers, especially if they check the box on a foreign disregarded entity to become a foreign corporation, and there's foreign goodwill going concern in there. This is a pretty common transaction where you have a U.S. company checking the box. A host of rules come into play whenever you do an outbound transfer. The focus here is, let's assume for the sake of discussion that there's a good amount of foreign goodwill going concern in that foreign branch when you check the box. Under current law, taxpayers generally have an argument that foreign goodwill going concern isn't taxed in this 351 transaction. One argument is, well, if foreign goodwill going concern is not a 936H3B intangible, then 367A applies to the transfer and it qualifies for the active trade or business exception. If they think it is a 936H3B intangible, you might say, well, gee, there's an exception in the 367D regs for foreign goodwill going concern that exempts it out. So at the end of the day, to the extent it's foreign goodwill going concern, under current law, taxpayers generally aren't going to be taxed on that outbound transfer. There's been a lot of battles between the IRS and taxpayers on what is foreign goodwill going concern. Generally, the IRS will try to say that that's some other type of intangible that would be taxed under 367D, under a deemed royalty, a system, a process. Taxpayers generally want to say, no, it's foreign goodwill going concern, not taxed. There's legislative history supporting the carve-out for foreign goodwill going concern when you incorporate a branch like this. The IRS and Treasury has issued a proposed reg that basically would say, if you do this transaction, we're going to tax you. Now, they didn't come out in the proposed reg and say foreign goodwill going concern is a 936H3B intangible, even though they've said that on numerous occasions. Some court cases would suggest that maybe it's not, Veritas. But at the end of the day, they said, okay, taxpayer, if you believe it's a 936H3B intangible, we're taking away the 367D carve-out for foreign goodwill, so you're taxed under 367 367D. If you believe it's not a 936H3B intangible, we're going to modify the definition of the active trade or business exception under 367A, which a lot of taxpayers rely on to get an exception, so that foreign goodwill going concern can't be taxed, or you can't qualify for the exception under the active trade or business exception. At the end of the day, this reg would basically say, to the extent you have foreign goodwill going concern in this outbound 351, you're going to be taxed either under 367D or 367A, and it has this election that if you believe you're in 367A, you could apply the 367D rules to have it deemed royalty. Now, the big picture about this is if you look at the effective date in the proposed reg, the proposed regs would apply to transfers occurring on or after September 14th. Now, it's not clear whether the IRS and Treasury will keep this proposed 2015, I'm sorry. It's not clear whether they'll keep this effective date. Obviously, today, if you did the transaction, since we haven't had any final regs, you could assert that that foreign goodwill going concern isn't taxed. If they keep this effective date and they finalize the regulations tomorrow, that same transaction that qualified for an exception could retroactively not qualify for the exception. There's been a lot of comments to the IRS and Treasury about this regulation. Many comments asserting, hey, the legislative history clearly envisioned that some exception be provided, and what you're doing in this proposed reg is essentially eliminating it, that maybe you're going a little too far with what your approach.
A lot too far.
A lot too far. So I think this is one of those regulations that are very high on the IRS and Treasury's list of items that they're trying to get out before the administration ends. So this is something that we probably will see some guidance on in the near future. The hope is that they will retain some exception for foreign goodwill going concern, if for no other reason because of the strong legislative history suggesting that there should be an exception. And if they don't, hopefully at a minimum they won't keep this retroactive effective date. Obviously that was put in place so that taxpayers wouldn't, and from the time the proposed regs were released till finalization, do their check-the-box transactions to avoid this rule. So this is a wait and see. It's a high priority. The IRS and Treasury said this is one of the higher priority proposed regs that they're trying to finalize. So this is something to keep on your radar. This is a very common transaction where U.S. companies incorporate branches. So keep this on your radar.
Yeah. So while we said there's some questions about authority in the 385 rules, I think there's some stronger questions about authority here. And I'm going to say it a little stronger than Joe did. When taxpayers incorporate a branch, they relied on the statute, they relied on the regs, they relied on I think, very, very clear legislative history that is in both the House and Senate reports. This says ordinarily foreign goodwill and going concern will not be subject to tax. I mean, how much more clear does it need to be? And then they also have policy arguments. So this rule, I think, is about getting at the valuation fights that are going on. This rule is a rule of frustration that was put out. I think it has some real issues. I do think if they go forward with it, even if they go and try to be nice here and make it prospective, this rule, I think, will end up in court, and a court will decide the validity of this reg, unless they really carve back on it in some way.
Yeah, and that is the hope. They have gotten a lot of comments on this rule, and in my mind, this rule has pretty broad sweeping impact to a lot of taxpayers, smaller companies, larger companies, and the amounts you're talking about, you could have a branch out there that could be, $1 billion branch, and 500 million of it could be foreign goodwill going concern. So those are the stakes that you're talking about. 500 million either avoiding tax under the current rules or being potentially subject to tax either under 367D or A. And so the stakes are pretty big, and the number of taxpayers this proposed reg can impact is very, very large.
Yeah, I think that's right. So let's just kind of say a couple things about treaties. If you can just give me that clicker real quick. I'm not going to go into great depth, but I think one of the questions is, well, let's say a couple things. So earlier this year, this spring, I guess it was, Treasury put out a new U.S. model tax treaty. A U.S. model tax treaty is really just an articulation of what the administration thinks is the opening position or the opening bid of Treasury at the negotiation table with other countries. And I'm not going to talk about the details of the changes because we don't have enough time, but leave it to be said that it is a really significant revamp of treaty policy, both with respect to limitation on benefits as well as other issues. And one question, from the outbound, inbound community, where it can be relevant for both, I think outbounds and inbounds have generally said, well, shoot, we haven't seen treaties get through Senate Foreign Relations since what? We have treaties that are dating back to 2009. So we're not going to pay attention because Rand Paul is likely to still be in office and these treaties are not going to move. So I want to kind of talk about this in that context because it's fairly truncated then and it's easy to kind of just be the most relevant stuff for those in the audience. And I think by and large, I think one of the questions we've all had is, one, will any treaty move, let alone one that is based on the new U.S. model? And two, what country would ever agree to the new U.S. model? They have a treaty that's far more favorable. Who would ever agree to this? Couple things to say about that. So
Singapore.
one, well, if you have no treaty, you might be willing to, yeah. But so I think one question. So I think in that vein, sort of who would ever agree to this? One, the U.S. has not really been actively participating in the multilateral negotiations. So I don't think there's an expectation that they'll get it done there. So then it becomes even more hard to believe how would they ever get this thing negotiated with another country, given that it's bilateral, right? Both from a efficiency standpoint as well as commentators have commented that there's a first mover disadvantage in the way this treaty is crafted for a variety of reasons, but there's a first mover disadvantage. So given all of that, why would anybody ever agree to adopt some of these provisions? And what I will say is that there are two treaties under negotiation that we know of that are going to adopt pieces of this potentially. The first one is the U.S. Lux Treaty. The U.S. Lux have announced that they will adopt a provision in a protocol or something where they will shut down on quote-unquote U.S. branch structures where you have a U.S. branch who is receiving U.S. withholding tax benefits under a treaty, but is not taxable in the U.S. And the only update to say there is that while the IRS indicated they've agreed to this and that there will be a retroactive change, the latest development is that Luxembourg was going to make some statutory legislative changes in order to enable them to do something retroactive. Their legislative authorities have said they cannot pass this, and that it is against the Vienna Convention. So the latest development is that it's looking like you won't see a retroactive provision in the U.S. Lux Treaty, and that Luxembourg would prefer to go forward with a competent authority agreement, which is likely to be prospective. The second thing, and then I'll turn it back over to you, Neil, is that the Irish have announced early fall, I think it was September, right, that they announced that they were looking for comments from the Irish and U.S. taxpayer community because they were entering into negotiations with the United States to adopt a treaty that had some or all of the new U.S. model provisions. And they wanted comments from taxpayers in October. There are two things that come to mind that the U.S. could be interested in with Ireland. One is inversions. There are some inverted companies that are Irish top code, and there are a lot of anti-inversion provisions in this new U.S. model that would provide for inverted companies not getting benefits. The second is the IFL structures, the interest-free loan structures that we're seeing so much of, that I've got a picture of on the board. There is a special tax regime proposal or provision in the 2016 model that would potentially treat IFLs or the lack of transfer pricing rules in Ireland if you don't have a trading company as being a special tax regime. So those are the two things to sort of keep in mind just in terms of what may be a real-world impact of this potential U.S. model, or this U.S. model.
And I'm going to go out on a limb. We haven't been able to, I've been checking my email up here. I've been sending a message out. My understanding is there's another European nation, I'll even narrow it to Scandinavia, who may be looking at negotiation right now, too. So there may be some...
In accord with the new U.S. model.
In accord with the new U.S. model.
Some version.
Right, or some pieces of it.
Yeah.
So there may be some momentum, although it's hard to see where the model will go. We'll have a new administration, whether it be Democrat or Republican in, and whether they just, throw this out and take another approach, who knows?
And whether they can get these retroactive changes done, because you got to get through Senate Foreign Relations. The only way to deal with the impasse there is to do retroactive provisions, and right now they're being stymied by Luxembourg, I think, in trying to do that.
Well, that concludes our panel. Thank you, Gretchen, Mike, Joe.